Do you think you could turn the camera off for the recording?
Yeah, Lorenzo, you can turn off your camera unless you want to be on
Okay,
YouTube famous.
sorry.
You can leave it on if you want.
Okay.
So let's see.
I don't think we're sharing the screen now.
Are we recording yet? Okay, we're recording. You wanna do the screen?
Instead of a window?
Yeah, this one, you can only see the presentation.
I can never remember that. So does he go stop presenting
Stop presenting up top.
at the very top?
Yeah, the middle one. You can say stop presenting, and then if you go back to share where
The,
you
at the
were
top?
next to
On
the
the
right
right.
leave button, yeah, and then select screen
Screen
instead of window.
Platform.
on the left?
Yeah.
There you go.
Yeah, now we're sharing everything on your screen.
Yeah.
Okay. See the red thing tells you.
Mm-hmm. So it's
Yes.
still sharing.
Okay. So let's see, we talked about the MD&A last time, which is our first RSI. So it kind of goes introductory section, audit opinion, MD&A, which is RSI, required supplementary information, and the basic financial statements. And then we go back to RSI again. Then it has budgetary schedules for the general fund and any major special revenue fund. And that's one that trips up a number of people. And that's a one to put debt service or capital project funds in there. We've never had a debt service fund or a capital project fund be major, but I've seen it happen like school districts and things, so. It does happen. And then you have notes to the budgetary schedules. And reconciliations of budget to GAAP. And then any pension and OPEB disclosures. So for us, we do our first general fund budget to actual. There will be another version of this in OSI, other supplemental information later.
Okay.
In the document. But this one's covers the revenues. And then what's different from this one to the later one is this just summarizes expenditures, where the later one breaks down general fund expenditures by bureau. So it'll have OMF and police and fire and each one of the individual ones, because that's the level that we adopt the budget at. And
At the bureau level?
Huh?
At the bureau level?
And then there's a reason why we organize it and do the variance analysis the way we do, in that this is the level that we adopt the budget at. So personnel services, EMS, IMS, capital outlay are all totaled. And so this is the actual budget, adopted budget numbers. Then we don't compare to the actual until we come to the actual budget level. Because that's what's relevant for tax supervising, and the Department of Revenue will come in and look at this to see if we violated budget law.
So that's why we don't have individual,
Totals for each line?
Yeah.
You just do it at that
Pretty-
line right there? That's what they care about?
Yeah,
Okay,
and same with debt,
okay,
we adopt that in total.
okay.
But we break it down for information purposes, so people can see in more granular detail
But we're concerned with compliance at the,
Yeah,
Total level.
the variance numbers are where we're actually testing for budgetary compliance. And then the contingencies. And this always has to be zero. Because you can't actually charge to a contingency. If you wanted to use it, what you have to do is you have to do a budget, a bump, budgetary adjustment, and move it from contingency to wherever it is you actually want to spend it. Then we have our transfers. And then we come to a budgetary fund balance, and then we show how we get from the budgetary fund balance to the gap fund balance. So this is so in order to be a special revenue fund, which the general fund reserve and public elections and citywide obligation funds or budget are showing up as special revenue funds. And we do, back when we get to the OSI, we'll put those individual budget schedules in because they were adopted as separate budgets. But to be a special revenue fund, you have to have special revenue, which means you have to have restricted or committed revenue as your primary funding source for the fund. Where those three funds are primarily funded by cash transfers, which aren't revenue. So anyway, the reconciling items, loans receivable, we handle loans differently between GAAP and budgetary. So, but when we actually make a loan to somebody for GAAP basis, we debit loans receivable and credit cash. But for budget, we debit expenditures and credit cash. So the recognition in fund balance is different, depending on whether it's a budgetary basis or a GAAP basis. Internal loans are another one of the weird things. For GAAP basis, if you are loaning somebody money, another fund money,
to do.
you're debiting internal loan receivable and crediting cash. But for budgetary basis, we record it as a other financing use.
Okay.
So anyway, so that becomes a reconciling item. This is our mark to market entry. So that the budget people don't want that non-cash adjustment of investment basis in the budgetary fund balance, so we don't make that entry to budgetary basis. We just do it for GAAP. Inventories, modified accrual allows us to use either the consumption method, which is what we use for GAAP, or the purchases method, which is what we use for budgetary basis. So in budget, as soon as you buy something, it goes to expenditures. But for GAAP basis, if it's going into stores, it goes to inventory and doesn't end up as an expenditure until you actually take it out of the storeroom and put it into use. So that's another adjusting entry. And then this number should then tie back to the GAAP basis fund balance for general fund. Transportation is one of our special revenue funds that qualify as a major. And it's a similar type presentation. And again, they have a reserve fund that is her budget is showing up as a special revenue fund, but since transfers are the main funding source, it can't be a special revenue fund for GAAP. And then the mark-to-market internal loans and inventories are the other adjusting entries there. And grants right now, because of all the ARPA money and CARES money and just the hundreds of millions of dollars that we've gotten in grants money, has gotten big enough that it's now a major fund. Now, at some point here in a few years, it'll probably drop down to where it's not a major fund again, but we'll have to make a decision at that point, because technically there is a trigger that something has to be a major fund based on, 10 and 5% of total revenues, expenditures, assets or liabilities. But it's like something is, you feel like is significant, you can just say, okay, this is a major fund, even though it doesn't technically qualify. So rather than having grants fund go back and forth between major and non-major, and then the hassles of going into gravity and taking it out, and it may be, so we'll just make the decision to just have it remain major, even though it doesn't technically qualify as major anymore.
Interesting.
Make it better for consistency too.
Mhm.
Yeah. So, but for now, it's major, and our adjustments here are notes receivable and internal loans. And then we have some note disclosures related to that. And we'll have to update this for the internal loans. And then expenditures in excess of appropriation. And are usually some, but they're usually not in these funds. OPEB and pension have the same issue, and that you probably need to go into gravity and add another year now. Because it's supposed to grow to eventually be 10 years. And it could be at some point, you'll need to switch these to landscape
Mhm.
rather than portrait. So anyway, you'll need to be adding 2022. I think gravity just automatically when you rolls it. So you have to look in gravity, and if it's 22, 21, 20, 19, and 18, you'll have to add 17 as a new column. So these are some general disclosures just to try to get a long-term trend analysis, and why they went with 10 years instead of 5, I don't think it's useful, but for whatever reason, Gatsby thought it was useful, so. Anyway, these will be building up to 10 years.
Okay.
Our statistics is usually 10 years.
Hmm?
In the statistical section, most of the data are 10 years.
And that may be why they went with it. The statistical section, most of those have a 10-year trend analysis, so it could be that this Gatsby thinks 10 years is relevant. And so there's OPEB. Okay, just doing it here. So this is the PERS OPEB. And then this is the cities, I think. And the internal one has a little bit different disclosures. And then you have to talk about some of the assumptions. And then we got PERS. And how many years you got? 1, 2, 3. So there's still room for 2 more years. That is the PERS analysis. And then this would be the FPDR. And it's a little bit different disclosures, whether it's you're part of a cost sharing plan or an individual plan like our FPDR.
Hmm.
A little bit different disclosures. And that is that at RSI. Factors in introductory section, financial section, and this is statistical section. Introductory section has a table of contents, letter of transmittal, which Michelle writes that, and then it's signed off by Michelle and the CAO. Org charts. I think you sounded like you were working on updating some of those.
It should be updated now, yeah.
And official, I don't know if we've got all the current people there. And we haven't received our certificate yet. I did receive an email saying it was in the final review stage.
Okay.
Okay.
Oh, cool.
So we should be hearing soon. Once that's done, we usually send that over to P&D and get a print quality version of it that they can use here.
What do we do with that?
Huh?
With the print version?
It gets inserted in the Gravity as a PDF.
Oh, okay, so they turn it into a PDF for us?
Yeah.
Huh, okay.
And structure, act for, like we just kind of touched on, the audit report, MD&A, which is RSI, basic financial statements, and then RSI again, and then SIs, supplemental information. And the SI is the combining schedules and the budgetary schedules. I think I may have a link to the audit report. But if I remember correctly, AICPA has tweaked this again. I think they keep changing it just to see who's paying attention.
See if people updated.
It's a way they can find out what auditors are keeping up on the. But anyway. That's the basic audit report as of last year.
Where's the opinion? Is it there?
Here's the opinion.
There.
And we kind of touched on this a long time ago. It always struck me as being a piecemeal opinion. But they've finagled their way around it. They being AICPA. So we're saying that it's fairly presented in all material aspects, perspectives, and financial position of the governmental activities, the business type activities, the discretely presented component unit, each major fund, and then there's 5 major funds, so now we're up to almost 10 opinions. And the aggregate remaining fund information, I think, puts it at 10 actual opinions that they're giving here.
I have a quick question, Ron.
Sure.
I'm just wondering why, at the very end of our ACFR, we have also audit comments and disclosures. Why do we separate it from the audit opinion? That
Okay, so for most government audits, there's, sometimes you get into a small government audit where they don't require this. But the vast majority of audits have to comply with GAS, which is determined by the AICPA. And that's what this particular opinion is about. I also have to comply with GAGAS, which is driven by GAO and the Yellow Book. And that's what that second opinion is about, is a Yellow Book opinion, where this is an AICPA opinion. So we end up with two opinions based on the two different accounting or auditing standards.
auditing body.
So GAS is generally accepted auditing standards. GAGAS is generally accepted governmental auditing standards. So anyway, that's why there are two opinions, is,
Okay.
and that's what we're getting to here. So that's what this should be. So this one is in the very back of the book, and this is where they talk about compliance and internal control over financial reporting, audit statements. And really, they cover a couple things here, because they're not only trying to deal with what GAO is requiring, but the state of Oregon has what is called the minimum standards. And they also have to make an assertion here as to whether we complied with the minimum standards, and that covers stuff like budgetary compliance. Did PBOT spend most of their gas tax allocation from the state on transportation related issues? Did we comply with state laws related to debt issuances and that sort of stuff?
Have there ever been any instances of non-compliance identified?
Not in a long time, but yeah, I can't remember us having a minimum standard one.
What about a qualified opinion for the other?
I can't remember us ever having a qualified opinion. Now, in a second here, we'll move on to the single audit. And there have been instances where we have had findings under the single audit. But that hasn't happened in a little while. It could happen this year. As with the ARPA money, well, the CARES money too. We had a lot of subrecipients where federal government gives us money, and then we turn around and give a big chunk of money to Multnomah County and Home Forward and a bunch of different nonprofits. And we have a responsibility to do compliance testing to make sure that they spent that federal money the way that in compliance with all the rules. So considering how many nonprofits we're talking about and how many of them are small and not used to dealing with federal money and all the federal requirements, there could conceivably be a subrecipient finding. Sheila's team and Andrea in particular have been doing a lot of work around subrecipient monitoring. Andrea has come up with checklists and she's kind of doing some limited audit work. And pulling a sample of transactions, so they'll give her a list of all the transactions. And then she'll pull a sample and say, okay, show us your supporting documentation. So Andrea has been doing quite a bit of separate bin work, but hopefully it was sufficient, but with this big of an increase, it's conceivable. So that's the yellow book one. And then we got the single, so GAO, the Government Accountability Office, is who issues the yellow book and drives the governmental auditing standards. OMB, the Office of Management and Budget, from the White House, is who. Okay, so they put out what's called a uniform guidance, and within the uniform guidance is also kind of referred to as 2 CFR 200. And that's where all the rules are about how you can spend money. And I think it's subpart F within there is what triggers a single audit. And then they also put out a compliance supplement with additional requirements based by CFDA number. So CFDA is Catalog of Federal Domestic Assistance. And for every federal grant, there is a CFDA number. And then in the compliance supplement, it tells you which of the types of compliance testing you have to do for that particular grant. So anyway, see a little bit more about that here in a second. So this is our single audit, which gets issued. Some years we've issued them together, being the ACPR and the single audit. But the last couple, 3, we've been issuing them separately because it's a lot more work.
That issued on the same day as the statements now.
And that was part of it. Like with CARES, the compliance supplement was put out really, really late. I mean, I think they've already put out the compliance supplement for this year. So the auditors are able to do their planning now. But when CARES came out, I think the compliance supplement didn't come out until like October, November. So the auditors couldn't even start planning what they were going to do for compliance testing. So anyway, it was late. So this is kind of the opinion that goes along with that. I guess that was dated October 29th this year. But it didn't come out. It didn't actually come out until November.
What does the body of work for the single audit look like on our end? Like, are there a number of audit schedules that we put together for Moss Adams? Or
Yeah,
what does that
look
entail?
for it.
That's primarily driven by Sheila's group. And it starts with this, called CFA,
Mhm.
which is the Schedule of Expenditures of Federal Awards. So here's what we're talking about with CFDA numbers. So Department of Agriculture and Food and Nutrition, all of their grants start with 10. And then the point is after the period is actually telling you which particular grant program. So these are CFDA numbers. So any CFDA number starts with 10 is Department of Agriculture. And then the 3-digit suffix to it is telling you what the specific program is. So Sheila has to put this together, and she tries to do that in July or so. So we got Department of Commerce, we got 3 million. We got CDBG. Got two different types. We got the regular and then CARES. And we got a whole bunch of other kind programs. And then Department of Interior, we got a little bit. Department of Justice, we got a little bit. And then there's subtotals for each of the federal agencies. Transportation tends to be one of our biggest ones for any given year. And with we're up at 15 million total there. And now, once that infrastructure bill starts rolling out, we'll probably see a bunch more transportation projects. So this should grow dramatically. And Treasury, which CARES, which is the coronavirus relief fund, CRF, was 100 million. And then ARPA, which is the new big one, is also U.S. Treasury.
So quick question again, Ron.
Yeah.
So all these amounts, all these expenses are covered by ordinances. Am I correct?
But most of the spending happens in Fund 217, which is a grants fund, 218, which is the CDBG fund, and 219, which is the home fund. Now, there are some of this that is in other places.
Oh.
Like for Department of Justice, we have to report forfeitures. So if the police go in and raid somebody for drugs, they will seize cars and houses and personal property, and cash, and all that will go into a custodial fund until the judge does a ruling. And once the judge does a ruling, some of it will come to us and go into Fund 222, I think is a police fund. And then we have to report that on the CFA because it's a type of federal award. So in total, we had 220 million of grant funding. So the way this kind of works is you have type A and type B grants. And it's based on a percentage of the $200 million to determine whether it's big enough to be a type A or whether it's a smaller type B grant. Now, if you are a low risk auditee, which we are at the moment, I think they only have to audit like 25% of your total revenue. So in this case, they would have to audit like $55 million of our spending. Now, one way they can get to that is back here in our treasury total is 100 million. So just auditing that one type A program gets them their coverage that they have to do. Now, there's a second. So once you've got your coverage, then you have to look at, okay, what are the other type A programs? And has that been audited in the 2 previous years? And if there is a type A program that hasn't been audited in the last 2 years, then you have to automatically audit that particular program. You can end up, so just auditing that one program gave them almost 50% coverage, which is well beyond what they had to do. But they also had to go in and see if anything else had been audited in the last 2 years.
You know what the type A versus type B are?
Hmm?
You know what the type A programs are versus like type B?
I'd have to look it up, but it's a percentage of the, you take the 220 million and a percentage. So. And there's ranges in the subpart F, I tell you from 50 million to 100 million, you use X percent to be a type A. And so there's groupings of size and the percentage goes down as you get higher and higher.
Okay.
So I'd have to go back and look to see exactly what it was, but. And then we also have to talk about our loan programs. So this is their results. And for internal controls, they have to do, are there any material weaknesses and are there any significant deficiencies? And any non-compliance. So we're fine there. Now here it's telling you, oh, here's your threshold. The dollar threshold used to distinguish between type A. So anything over 3 million would be a type A.
Okay.
So in order to get coverage, they did the CRI. And this would have been one that hadn't been audited in the last 2 years that they were forced to audit. I think this year. Not totally sure, because we still have a CRF again. The ARPA ending started, but we didn't spend a whole lot of it. And then the big transportation grants, they haven't been audited in the last 2 years, so that'll get triggered as an automatic. So I'm not exactly sure. I mean, we've had times when we've had as many as 5 programs that got audited.
Just from things being required to be audited.
And
Who's kind of the lead person for that? Would that be Sheila?
there is a separate audit team that comes in and does this work. They just kind of specialize and they go from place to place, just doing the
Are you gonna
single
start
audits.
within Moss, you mean, or?
Yeah.
Oh,
So it is definitely a specialty. And it's interesting. I mean, when I did the audits, we did the entire thing. So I've done a whole bunch of single audits. It's a whole different thing. You got to do separate internal control testing for each one of these. And you have to pull samples from each one of these. So as far as the audit schedules, Sheila prepares the CEPA. And then Moss, based on the initial CEPA, will go through and pick the programs that they want to audit. And then Sheila will get them the populations and they will pick samples. And then somebody has to pull them.
Yeah.
So we don't get involved much with this, to this primarily Sheila and whatever bureau is responsible for the program that's being audited. Which for CARES was her again. But if we're doing transportation this year, then PBOT will get heavily involved and Anyway, that's kind of a quick overview of of how that works.
What is the fixing our streets audit come in? People always wants help on that. Is that like a grant on
It could be, because
it?
federal agencies will come in and audit separately, like the Department of Justice, which is here. Auditing the forfeitures.
Mhm. Okay.
So the original concept behind the single audit was each of the federal agencies didn't have to go into every government and do separate audits. But they still do it anyway.
Okay.
Extra.
But it doesn't happen as much as it used to. Supplemental budget reporting. So we present the budget schedules for funds with legally adopted budgets, which for us is every fund. But it varies from state to state, like in Montana for schools. It was only funds that had a tax levy that had to have a budget. Any other fund didn't have to have a legally adopted budget.
Hmm.
They need to be at the budgetary control level. Like we talked about earlier, we show more information, but only show the budget variance column for the level of budget control. The auditor issues and in relation to opinion on them. And of course, compliance with Oregon minimum standards. And we repeat the general fund here. So. Well, the revenue section is the same for this general fund as the other, but like I said, here we break out the individual bureaus, which is actually the level we actually adopt the general fund at. So I do, those are the general fund. And then we do our special revenue funds. BDS. Well, here's that general reserve fund. And its only real revenues are interest income, which is why it doesn't really qualify as a special revenue fund, but for budgetary purposes, we show it as a separate fund. This stuff. Yeah, I mean, conceptually, we're trying to take that $60 million and have it set aside for emergencies and they're under city ordinances, there are only specific times when you can spend it. And the council has to approve releasing it. And when they do, then we do a budget adjustment where we move money. Like most of that, this money is in contingency.
Mhm.
So you would have to do a budget adjustment, moving it from contingency down to transfers to other funds. And move it to another fund where it would actually get spent. And transportations is a similar type situation where they got about 9 million set aside for difficult times. And then most of the governmental funds have kind of similar reconciliations that we talked through with general fund and so when we get to our proprietary funds, in the list of reconciling items between budgetary basis and net position of the gap basis proprietary fund grows. Because for current financial resources modified accrual, you don't have capital assets, you don't have long-term debt, you don't have pension liabilities, don't have environmental remediation, landfill. That whole laundry list of differences. So anyway, it becomes a lot more challenging to come up with the reconciliation, but it's critical to do. Because we didn't used to do this reconciliation. And when we transitioned to actually doing it, we discovered a whole lot of funds were actually they weren't in balance. So anyway.
It's not required, it's just that we choose to do that.
Yeah. It may be required now, but I'd have to go back and look to see whether it has been required now, but it's a good practice. And after at the end of the book is our stat section, which has the financial trends, revenue capacity, debt capacity, demographics, and operating. So basically it starts off with government-wide stuff and showing net position trends over 10 years for governmental activities, business-like activities in the primary government. And then we look at the changes in net position for each of them. And then this is fund balances for governmental funds. So we talk about how that, and then what were the changes in the governmental fund balances. And then we break out, this is going back to government-wide, we're talking about program revenues by function. And then we're into revenue capacity. We're talking about property taxes, lodging taxes, arts. And PSEF is the newest one that has been added. And that one just keeps going crazy.
What is PSEF?
So that's the clean energy fund.
Oh, okay. That makes sense.
So it's basically a sales tax that's been placed on all the large retailers. So it shows you the power of a sales, even limited sales tax. And why so many people want to add a sales tax. And then we go on to assess valuations. And this kind of gives you an idea of the difference between market value and what we actually have as assessed value. So it's really more real market value, more than twice what the assessed is. Which has a positive effect. So like when real estate tanked back in 2008, 2009, our property taxes didn't really change at all. Because all that happened was the real market value just started coming down closer to what the assessed value was. And we really didn't see any loss of revenue, even though real market value tanked. So anyway, it is advantageous to us, but. And this is a tax levy by district. So this is ours, the city. So we got general, special revenue, and debt service. And then the county and schools and Prosper Portland. The port and metro. And this one always kind of fascinates me because these are principal taxpayers, and as of last year and then 10 years prior. So it's kind of interesting that like Quest was a big player 10 years ago, but I don't think it exists now. Fred Meyer, I don't know why they have disappeared. That
Oh, it's because they're not in the top 10 anymore.
that could be. Yeah, they could still be 160 million and just have disappeared.
Did Quest become CenturyLink?
Could be.
Oh, yeah.
Mm. Oh, yeah.
Yeah. Yeah. Yeah, that could have been what happened there. The property tax levies, like dollar amounts. And ratios of outstanding debt, so we're looking at the different types of debt that we have in total. Then GO bond, debt outstanding. And then overlapping debt. So this kind of gives you a better idea of what the entire debt load is on the urban area. Not just what is city of Portland. So I think we have $1 billion, but the entire urban area, you're looking at almost $4 billion of outstanding debt. Legal debt margin, we're not even close to what we could issue. And this is just a general obligation debt. Flood revenue for the sewer system. So this is a required disclosure related to the bond covenants on the revenue bonds. So there's required to meet a certain coverage, and I don't know what that is. I think it's like maybe 1.5. So it's looking to make sure that they're actually generating enough revenue,
To meet their commitments.
net operating revenue, in order to have money left over to make the principal payments. So we do that for sewer and water. Then we get into demographics, where we're talking about population and personal income. And then we do something similar to the property tax payers, who are our biggest employers.
Oh, yeah. And so
So it's as of this year, and who was it 10 years ago?
Mhm.
I don't know why the state and the feds dropped off. Could just be that maybe they moved somewhere else. Full-time equivalents for the city, so we're pushing up towards 7,000 employees. And so operating indicators and There are probably some better ones, but. Or tend to be doing the stats section very late in the process, so. So we just kind of update what we've been doing. But if you look at the budget office's website, they have all sorts of indicators in there. So at some point it might be worthwhile to see if there are some better ones. But. Then the capital assets. So like number of fire trucks and fire stations, police precincts,